This episode, we're going to break it down, the top 10 things that we'll see questions from clients about. Can I do this? Can I not? This is not rocket science. Don't think this is complicated. This is like the board game. You just need to know the rules before you play it if you're going to execute it properly and win the game.
One of the number one mistakes people make is they get excited about, I'm going to self-direct, and they go commit to a deal.
That's the cart before the horse. And the right way to do that was get your account set up, get it ready. Maybe you don't have all your money over into it sitting in cash. Maybe you have some in the market still, but just get maybe $5,000 over in your self-directed IRA. So when you find a deal, you can get it in the name of the IRA. All of your investment documents need to be in the name of the IRA, whether you're buying real estate in your IRA, you're investing in a private fund. The subscription documents, for example, will be in the name of Directed Trust Company, FBO, your IRA. It's not in your name. Like if I'm investing in my IRA, I'm gonna put Matt Sorensen on the documents, or even Matt Sorensen's LLC. It's Directed Trust Company, FBO, Matt Sorensen IRA. Give yourself a couple weeks though, to get the account open, get the money moved over from Fidelity or TD Ameritrade or wherever your current IRA funds are. And I would say 3 to 4 weeks is to be safe. Usually we can execute it within a couple weeks. So just have a little planning. Don't put the cart before the horse. Number 2 is one that might seem obvious for some of you that are familiar with this, but for a lot of new people, they miss the point of this whole thing. And they think, oh, I'm gonna buy assets from myself with my IRA. Oh, well, I already own this piece of real estate. I'm just gonna buy it from myself. Or it's, oh, I've got these private shares in this company, or maybe these stock options that I've earned personally, and I wanna get those over into my Roth IRA. Well, your Roth IRA can own private shares in a company, but not ones that you've personally earned or that are your personal shares you've already bought. So just keep in mind, your IRA is buying new assets, okay? New investments. It's not buying stuff from you, your spouse, your parents, your kids.
That's going to be a number one.
Okay.
Oh yeah, you're broken to 3.
Okay.
So I think number 2, I like number 2 is
you're
you're thinking you're going to do something with yourself. You're going to buy something from yourself that you already own. I'm going to say number 3, which I think is is in another category, is you might think you can buy something from my mom, my dad, some family member, or even a business partner is brought to the level of a prohibited party. I'd say number 3 is transacting with a prohibited party. Again, kids, a spouse, parents, anything like that. Number 4, what do you think?
What I would say is investing into a company you own 50% or more of or control. Okay, this is an important rule. We have a lot of people that are like, hey, I have a company and I want to invest my IRA into that company. Can't do that. What if I own 10% of the company? Can my IRA invest? Yes, it can. Okay, there's something called a 50% rule. So your IRA cannot invest in a company where you own or control 50% or more, or any of these disqualified people, these family members Mark was mentioning a second ago. So yes, your IRA can invest in small businesses and companies, even ones you're involved in, but not ones where you or disqualified people control, okay? That's where you're gonna need to get with a lawyer to know the nuances on those rules if you really wanna press that. But as a rule of thumb, your IRA is investing in other people's deals or in companies that you might be personally involved in. We've had people, it's like, hey, I'm invested in this private fund or this company. I own 5%, but I wanna get more shares with my IRA. Cool, you could do that. Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement.
Okay, number 5, thinking that you can work in the company or work on the asset once you do buy it. No, you cannot work in the asset or on the asset in a substantive way. And maybe, Matt, you can explain being the manager of an LLC is okay, but that actually getting in there and working as if you were an employee or an officer or manager, how would you describe it?
Yeah, I mean, I think it was interesting how you said it. Working in the business versus kind of on the business type stuff is okay, where you're kind of in management, administrative oversight. The IRS wants you to do that. I mean, the tax code is not going to restrict you from when your IRA invests in an asset to overseeing things like, let's say, the rehab property. Like, you can go to look at the property before you buy it, make sure it's a good property.
You can write checks.
You can write checks, even with the IRA LLC structure that many investors use for real estate deals. Where you're manager of the LLC, you have a checkbook. If you're like, what are you guys talking about? We've got other podcast episodes on that and videos, chapters in my book, but you can't pay yourself. You can't provide physical labor onto assets, okay, where you're improving the asset itself. Administrative management, oversight, decision-making, totally fine, do that all day. So on the rehab, I could go and I could tell a contractor what to do, make sure they did it right. I just can't be the one doing it.
All right, number 6, what do you got?
Okay, let's hit the pay one just because I mentioned it there. So if you're doing any type of structure, let's say your IRA's investing into real estate, again, a lot of real estate examples because it's common and a popular asset. Let's say that you happen to be a real estate agent, all right? And that there's a 3% buyer's agent commission, and you're like, well, I'm an agent. My IRA is going to buy this property for $300,000, so I can get a $9,000 commission. That will cause a self-dealing prohibited transaction, okay? And so we want to avoid that. Now, what you could do is you could waive the commission in that example, reduce the purchase price by $9,000. It's okay for your IRA to benefit, but you just can't receive the compensation. So I'm okay with you being the agent on this, so to speak. It's just the compensation piece to you where you make money because your IRA invested in something.
So you're okay them being the agent and waiving their fee? And didn't I just save my IRA paying another realtor? Like I've added a value to my IRA without... I didn't think you could be the agent at all.
It's not physical labor or physical improvement of the asset itself. And so I don't see any issue with it. You don't have to use an agent to buy the property. You can negotiate the commission down anyways. So, I don't see it, and you're not paying the commission. The seller's paying the commission. The self-dealing rules are what tie you up from you to make money personally. And so if you think about it, the way, if you actually read the tax code on this, the self-dealing rule is specific about the person of the IRA account. It's not about the IRA benefiting. That's all. The IRS is cool with the IRA benefiting the other way around. It's about you personally benefiting, making money. Now, on like physically improving an asset and not paying for it, you could say, well, the IRA is benefiting. But I think the physical nature of that is where you've seen the IRS talk about it. There's actually not cases about it, but you've seen like some IRS talk about that's probably prohibited. So if I feel comfortable on the commission thing, just waiving
definitely
that.
Don't take it.
Don't take it, but just waive it and negotiate the purchase price down.
Okay.
On the other hand, let's say that you didn't use an agent, no agent, your IRA just buys it. It's very common, and it would be almost irresponsible for your IRA to overpay, right? Why would I have not asked for that? A lot of times when you're negotiating the sell price anyways, it all nets out anyways. So
I like
you know what I mean?
Yeah,
it's not like it's on a HUD statement or anything. It's like, hey, you don't have to pay that 3% buyer's agent commission. Instead of me paying $300,000 for this, I'm paying $291. Okay, my IRA's buying it.
All right, now number 7, I'm going to bring up using the asset. So let's say your IRA, you buy it properly. Remember, we got timing. You buy it from the right person. You get in there. You're like, okay, I'm not going to work on it, and I've got this Airbnb, a short-term rental sitting in my IRA. I did it all right. I paid the right people to get the work done. I didn't pay myself. I could go use it. I'm going to pay rent like everybody else. Or I think most people go, yeah, I can't just go stay there for free. I mean, it's in my IRA, and that's right. You cannot, but you cannot even pay fair market value rent and go stay there. That would be prohibited. So the use of asset, does that fall into the self-dealing, or what would you categorize that
I mean,
as?
if you use it and don't pay for it, it's self-dealing. If you use it and pay for it, it's what's called a per se prohibited transaction, because you're a disqualified person paying your IRA, which is what the per se prohibited transaction. So either way, the tax code got you on that one. No, you're in the crosshairs either way. So it's like, just don't use it. So the next question, of course, typically is, but my brother and sister aren't prohibited. What if I let them stay at it and I come over and visit?
Now, that's a good point. Let's just say that right now. Brothers and sisters could stay there, but my kids couldn't. See, this is why buying a long-term rental near a college that you love, and you're like, oh, my kid just turned college age. They can go stay in there and pay fair market value rent like anyone else. So I'm being fair. Nope. Because your children are disqualified parties, your spouse and your parents, that's the same. They cannot use that asset.
All right, number 8. The next one I want to hit, for those of you that have an IRA LLC, but rather than your IRA owning the asset, the IRA invests into an LLC, and the LLC owns the asset.
Love it.
One of the common mistakes people make is they think, I own this LLC, let me just put more money into the LLC for a contribution. I want to take money from this LLC, I'll just take money from the LLC and transfer it to my bank account, and that's a distribution.
Yeah, or I want money from my IRA, I'm ready for a distribution. It could be a Roth, it could be whatever, and you may be entitled.
I'm 59 and a half, I can take it out now, it's no penalty. No. You don't own the LLC, your IRA does. So when you want to put more money in an IRA LLC, that doesn't come from you, that comes from the IRA. So you'll send money to your self-directed IRA custodian, directed IRA, of course. And then you'll say, hey, directed IRA, invest this additional money into the LLC, and then we'll send it to your LLC bank account. Same thing. You want to take money from the LLC, send the money back to your IRA, a directed IRA, and then we'll process a distribution to you. So just keep in mind that you have to pass that step of the IRA. This is an IRA LLC. It's 2 things, and you got to make sure you're doing the flow of funds properly.
The next one, in this example, remember we're putting money into the LLC or out of the LLC rather than follow the proper channel. Maybe you're deal does need more money and my IRA has to contribute more. So let's say you realize it's got to go in through your IRA, but you're short or you didn't foresee this. And so this is one of the pitfalls in this top 10 is that if there's one thing I'd say here, what I want you to be aware of is understanding how to put more money in if it's necessary. Because if you've got multiple IRAs in this at different percentages or 401ks or HSAs, and you need another 10 grand or you need 50 grand, can you? What would it look like?
All right, let's hit the other one here that we haven't brought up.
That's number 9. This is number 10.
I want to talk about UBIT and then UDFI.
Is that a bad thing or just not?
I'd rather not have it, but not seeing it would be the mistake. So there's a tax called UBIT or UBTI that can apply to certain IRA deals. Basically, IRAs are designed to receive investment income. When your IRA receives investment income in an investment, it doesn't pay tax. But if it receives business income, IRAs are subjected to this UBIT tax. Let's say your IRA owned shares in Buffalo Wild Wings, and that's an LLC, pass-through entity, no corporate tax being paid. Then your IRA's share of profits would be subject to this UBIT tax, which is 37% max. Now, let's say your IRA is invested into a C Corp. That's the Buffalo Wild Wings, the local restaurant or whatever business this is. It's an operational business here. Now you're getting dividends. That's exempt from UBIT. Now you can use a C Corp blocker. You could add in the middle anyways, even if it's in an LLC to pay 21%. We have a lot of clients that will structure for that depending on the deal. So it's just something you need to know about. Doesn't apply to most self-directed investments, but can apply. So make sure you're aware of that UBIT tax. Have either a tax advisor on your team or get a consult with the lawyer if you're in those types of deals. Again, you don't need a lawyer for everything. We keep dropping that sometimes, but I'm just saying, like, if you get down a rabbit hole on this, that's when you call for help. But we have the resources, the books, all this stuff you can read up on it to be pretty well versed on this, so you're going to know where you're going to hit it or not.
UBIT's not bad. It doesn't mean you don't do a deal if there could be UBIT. It's not that the tax is there that's bad. It's that we didn't see it coming. What's UD as in David FI? I could deal with UBIT.
This is unrelated debt financed income. What this is a tax that can apply when your IRA invests in something and gets debt to increase the purchasing power. For example, you're buying a property for $300,000 with your IRA puts in $100 grand and you get a loan for $200,000 to acquire. Now, when you do that, that loan needs to be non-recourse. We've got other podcasts on that. You can't guarantee the debt, but there are banks that lend to IRAs buying real estate.
Love the strategy.
Love the strategy. Now, you pay tax on the profits from the debt. That does not go tax-free back into your IRA or tax deferred. And that's not the end of the world, because what did you do? You bought a $300,000 asset with a $100,000 account. You're not doing that in the stock market, or you're not doing that with your mutual funds or ETF. You're buying a $100,000 asset. We're only paying tax on the $200,000 of more assets we are able to buy. And so that is this UDFI tax. There's some little strategies and workarounds sometimes to avoid this. Solo 401ks are exempt from it in real estate, but just a little note there, when you're using debt to leverage and buy more assets with your IRA, that UDFI tax can apply.
So hopefully that helps. It's not a bad thing, but again, you want to be aware of this. Knowing how to plan for it is the trick. So that's 10. And I love those 10. The UBIT and UDFI kind of fall in that number 10. Is there any bonus
I'll do one bonus, and that's just for any of you that are a little older investing. You're maybe in your 60s or early 70s. We have clients that are self-directing in their 80s. Geez. And so you might have an illiquid asset. And if you're using a traditional IRA, like I've had a couple of clients over the years that have bought like land, right? Or they're in a private fund that's illiquid and not spitting out money. Well, if they invest the whole count into that asset, you have to start taking required minimum distributions at age 73. Well, if you have no cash coming off that asset, it's hard to take it. You can do what's called an in-kind distribution, where we take a piece of that asset out and it gets distributed to you personally, and it's in your personal name now, like a tenant in common interest on a deed for real estate, or a certain percentage of the units in the private fund. But it is not the fun way. It's a kind of a pain in the butt. You have to get an appraisal and to value the asset. So beware being 100% illiquid when you're in traditional accounts. Roth IRAs don't have RMD, but for traditional accounts where you could have RMD, which starts at 73.
Great bonus. Well, everyone, here's the moral of the story. Knowledge and knowing our path reduces fear and stress, and we can make better decisions.
Yeah, and I think once you get in the habit of self-directing and you kind of learn the deals you like to do, which is what most people do, they end up doing a lot of the similar stuff. They get good at a specific strategy or an asset they like and learn about and have confidence in. It's the same thing over and over, okay? It's like the rules don't change that much. I mean, even as long as we've been doing it, it's just a little thing here or there. So we keep you up to speed on all that stuff. So thank you for being with us today. Until then, stay calm, self-direct on.